Joe is your average American. He works as an IT manager and has a family, a wife and 2.3 kids, and a dog named Spot. In the last few years, Joe's monthly expenses have been steadily rising. Ever since the pandemic, the demand for goods has exploded and prices on everything are through the roof. Specifically, Joe pays an extra $200 a month on his grocery bill, and gas costs $4 a gallon to fill up the tank on his Ford F-150. Joe is mad about inflation. He takes his anger out on the government and would like them to do something about it. Then, Joe catches the news and hears that the Federal Reserve is talking about inflation, and he's excited. At last, they will fix inflation and my monthly bills will stop increasing, he thinks to himself. Then he hears them talk about how they are focusing on core inflation. Not knowing what that is, he looks it up and realizes that core inflation excludes food and energy prices. Joe suddenly becomes angry again. How could they not care about food and energy? I have to eat. I have to drive my car to work. Why won't they do something? Do anything about this? Today, we're going to talk about inflation metrics. What is core inflation and what is headline inflation? And why does the Federal Reserve and other central banks focus on core inflation when food and energy prices have a major impact on our monthly expenses? Before we dive into why the Fed looks at core inflation, I want to give a brief description of the two types of inflation the media likes to talk about. You'll most often hear about headline inflation and core inflation. What's the difference? Well, headline inflation is the change in prices of all goods, commodities, and services in the country's economy. Well, at least the goods and services that are measured for the sake of calculating the metric. But that's a whole different discussion that we won't get into now. Core inflation is the change in prices of all commodities, goods, and services in the country's economy, excluding food and energy prices. Core inflation is often considered a more stable metric because food and energy prices can be quite volatile. Food and energy have been quite literally securitized on the commodities exchange markets, and as a result, they are essentially traded like a stock would be on Wall Street, and thus more volatility is introduced to those prices. For example, if there's a bad drought in a major wheat-producing region of the world, it'll drive the price of wheat up. If that same region also happens to be the number one producer of glucose meters to measure the blood sugar levels of diabetics, well, the weather's not likely to have much of an impact on the cost of those meters. So that's the main difference between core and headline inflation. If you are enjoying the video, please give it a like and consider subscribing for more business and economics content in the future. When it comes to setting economic monetary policies, the Federal Reserve and other central banks around the world focus on core inflation numbers, not headline. Now you may be thinking, well, food and energy are major portions of my monthly paycheck. Why don't they care about those? And indeed, food and energy spending makes up somewhere between 15 and 20% of the American household budget, which is a big chunk of change. So you would want the government to care about that and do something about it, right? Well, I hate to break it to you, but the Federal Reserve has very little direct control over food and energy prices. As we mentioned earlier, they are largely sold and driven by commodity prices. Those prices are set at a global level, not a local or country level. When OPEC decides to cut production of oil in the Middle East, can the Federal Reserve do anything about that? Nope. And when Russia decides to invade Ukraine, and as a result, most of the Western world decides to place severe economic sanctions on them and cut off imports of Russian oil, again, out of the hands of the Federal Reserve. All of these things are volatility-inducing events that can drive up the cost of your food and energy bills. The Fed does have some indirect control over these elements, but they do that by focusing on core inflation and how they can directly impact economic activity in the US. So getting back to the focus on core inflation, the Federal Reserve and other central banks like to focus on that measurement because it is more inside their control. The monetary policies they set will have an effect on either increasing or decreasing economic activity in the country. If economic activity decreases, well, that means people are demanding less goods. The lack of demand will alleviate pressure on rising prices of goods and services, and because you have less people willing to buy, the suppliers will not attempt to raise the price because they could jeopardize their revenues as a result. Take, for example, housing. The housing market has been red hot in the United States ever since the pandemic. With the Federal Reserve raising interest rates, that will make mortgages more expensive for the everyday would-be home buyer. If those mortgages become too expensive, then it prices some home buyers out of the market. When the pool of potential buyers drops, then the bidding wars for these homes should subside and the market may become more of a buyer's market. In more conventional industries, the raising of prices and costs costs of production are more sticky. This means that they take longer to respond to different impacts to the macro economy. So when the Federal Reserve sets their monetary policies to raise interest rates, it may take a while for the business to feel the impact of that and slow down the price increases they had planned. And because core is more sticky, this means that when central banks start to move the needle on it, we can be more certain that policy is having its intended effect or not. Because if you left the volatility of food and energy in the measurement, it might wash out your trend that you're looking to see. And to some extent, food and energy prices should follow the core somewhat. If business activity starts to slow down due to central banks' monetary policies, they might also begin to demand less energy and expensive food commodities. For example, if you have fewer goods to ship because people are buying less of your products, you're going to spend less money on fuel costs. So that is essentially why they focus on core measurements of inflation. Yes, I realize that we do have to eat and most Americans do need gas to get to work, so the inflation on those categories is a real problem for the everyday consumer. But the central banks are much better off focusing on core segments they can control. Rather than chasing the noise of food and energy prices they certainly don't have any major control over. If you found this video helpful, consider checking out the one on the screen now. Thanks for watching, and I will see you in the next one.